So you have made $200,000 last year, but you're about to write a hefty check to the CRA for taxes. Well, what if I told you there's a legal way to keep $15,000 to $30,000 within your pocket? But don't think CRA doesn't know, they actually know. And in this video, I'll show you 5 tax loopholes that top Canadian small businesses can use to reduce their tax bill. And most accountants won't even mention this. If you're serious about keeping your hard-earned money with yourself, grab our free tax loophole guide. It's linked in the description and pinned in the comments. Because by the end of the video, you will know exactly how to use these strategies starting today. But before we dive into the loopholes, let's get on the same page. These strategies aren't for side hustles or first-year startups. They're actually for mature, grown businesses and have been running for quite a few years. Here's a few assumptions that I'm making right off the start. In this video, you would need an operating company that's your active business generating revenue. The second is your management company, which handles your admin, planning, and that's how you pay your bonuses. And the third is your holding company, where you park all of your profits, invest all of your money, and protect it against any liability. This isn't just corporate jargon. This structure is the foundation of how high net worth individuals legally avoid paying a lot of taxes and build generational wealth. If you're still operating as a sole proprietor, these strategies won't be for you yet. But if you're here watching this video, it means you're thinking bigger. You're not just thinking to survive, you're trying to optimize. So let's get into the first loophole, one that lets you defer tens of thousands of dollars in taxes by simply timing a bonus. So loophole number 1. Double deferral bonus accrual plus fiscal year. You get taxed only once in the corporation. Then when you pull it out, you get another layer of taxes. But what if I told you that you could delay that second hit and keep tens of thousands of dollars working for you, not the CRA, for up to 18 months? Most businesses pay taxes on profits in their operating company, then they pay taxes again when they take money out of their corporation, whether it be salary or through dividends. It's like double taxation and it's actually draining your cash flow. So here's how you fix it. You first have an operating company from which you actually pay a bonus to your management company. The operating company must have a year end of December 31st and the management company has to have a different year end, which is, let's say, July 31 for our example's purposes. In step 2, operating company deducts the full amount of bonus this year, slashing its taxable income by the amount of bonus. So if it's 150,000, you saved 18,300 in taxes. Step 3 is management company doesn't recognize the income until the next fiscal year, thanks to its July year end. Step 4 is you draw the funds from the management company even later, creating a total deferral of 18 months, which is interest-free, tax-free, and fully compliant. So let's look at an example. Let's say you have an operating company that earns $150,000. Without this, you would actually end up paying $18,300 in corporate taxes and the money is locked up. But with this, you save $18,300 now and you invest it for 7 months at 5%, which is another $4,400 in benefits. So you got a total benefit of $22,000 odd, which is not bad for your next board of directors meeting. And if you're pulling in $500,000 and you declare $200,000 of bonus, that's like $24,000 in saving. And on, like, if you were to invest that, there's an additional like $10,000 that you can make in 18 months, which works out to $34,000 in savings. So now this isn't a loophole. It's a legal timing strategy, but the CRA will and can audit it. So what you need to do is you need to make sure that a management company providing real services has already been set up. The board resolution declaring the bonus, an intercompany agreement is also needs to be there, and the bonus must be paid within 179 days of the operating company's year end. And if you have no documentation and no proof of services, that's a red flag, and the CRA will disallow the deduction. This isn't just about saving tax, it's about cash flow freedom. And if you think this is amazing, wait until you see loophole number 2, where you pass on wealth to the next generation while still in control. So let's assume you've built a business like myself and the profits are piling up. But if you pull money out as a dividend or a salary, the CRA will take nearly half of it. So what if I told you can take away $1 million tax free while you're still alive and not after you're gone? So what happens is, most owners think that they have 2 choices: leave money trapped in the corporation or pay massive dividend tax when they take the money out. But there's an actual third option, one that lets you unlock retained earnings without triggering a tax bomb. It's actually called pipeline planning while alive. So step one is you own shares of an operating company personally. They're worth around 800,000 based on, let's say, operating company's retained earnings and assets. You incorporate a holdco. You sell your operating company shares to holdco for a fair market value of 800,000. Step two is in a normal sale, the buyer holdco would give you cash, which is $800,000, but holdco has really no cash in this scenario. Instead, holdco issues you a promissory note for 800,000, essentially an IOU. So on your books, personally, you now have an asset of $800,000, which is like a loan receivable from holdco. On holdco's books, it has an $800,000 liability, which is a loan repayable to you. Step three is Section 85 election. Why Section 85? Because without it, selling operating company shares to a holdco would trigger a capital gain on the sale right away. With Section 85 rollover, you control how much of the gain is recognized. You elect to reorganize the gain up to your lifetime capital gains exemption limit. That means you can crystallize the lifetime capital gains exemption. So no tax, but you bump the adjusted cost base of your shares. Step 4, OpCo earns profits as usual. OpCo pays a tax-free intra-corporate dividend to Holdco. Holdco uses that cash to repay the 800,000 promissory note to you over time. Each repayment is not taxable to you because it's a repayment of loan principal, not income. Let's say your operating company has $800,000 in retained earnings. If you paid it out as dividends, you'd owe $376,000 in personal tax. But with the pipeline strategy, you pull it out tax-free. Savings are $376,000, which is not bad for a few legal documents. Now, this isn't just a loophole. It's a CRA recognized strategy, but it's not simple. You need OpCo shares to qualify as qualified small business corporation shares. You also need to do a Section 85 election, which needs to be filed with your tax return, and a promissory note with clear repayment terms, and of course the coordination between your tax lawyer and the CPA. Sloppy paperwork, that's a red flag. The CRA will audit it. You can extract hundreds of thousands of tax-free money while you're still in control. But the next loophole takes it even further, where you legally move passive income out of your corporation. So you've built $300,000 in profit and you're ready to take it out. But if you pull it out as a dividend, there's $145,000 that goes straight to the CRA. What if I told you there's an actual legal way to get that money tax-free? It's called Safe Income Surplus Trip. And here's how it works. Step number 1 is you incorporate a holding company and restructure it so it owns operating company fully. Step 2 involves operating company pays a tax-free safe income dividend to a holding company, and yes, that's allowed under the Income Tax Act. Step number 3 is holding company records that money as retained earnings. Step number 4, it then advances those funds to you as a shareholder loan with no immediate taxes. Step 5 is before the loan becomes due, the holdco will actually declare a dividend to you, which basically repays the loan on paper. This way, you enjoy access to the funds immediately and the repayment is handled through dividends later. Now you must be wondering, hey, wouldn't this trigger dividend tax personally? Yes, it would. But if you download my guide, I shared and explained a strategy called share reorganization and redemption, which basically avoids this as well. Let's look at a numbers example. Let's say you have an operating company which earns $300,000 in safe income. If paid directly to you, you're going to have to pay $141,000 in dividend taxes. But with surplus trip, you get the money tax-free via loan from Holdco. The savings, which is $141,000 in this, and it's not by luck. That's actually called planning. Now, this isn't a DIY move. You need proper structure, proper tax lawyer, and a shareholder loan agreement. And you must track the loan because if you don't, the CRA will classify it as a dividend. And no documentation, that's an actual red flag. But do it right and it's 100% compliant. And if you thought this was clever, wait until loophole number 4, where you actually pay life insurance from your tax-free cash. You've been investing inside your corporation, but here's the problem. Every dollar of passive income gets taxed hard way. What if I told you there's a way to grow $200,000 into $1 million and pass it to your family tax-free? Most business owners think, I'll just invest the surplus in stocks or real estate. But that passive income it grinds down your small business deduction and gets taxed up to 50%. So you're not building wealth, you're actually feeding the CRA. Here's the fix. Corporate-owned life insurance can be used as a death plan, but it can also be used as a tax-free wealth transfer strategy. Step number 1 is your corporation buys a whole life insurance policy with you as an insured. This insurance policy has a death benefit component as well as an investment component. In step number 2, premiums are paid from after-tax corporate dollars. They're not deductible, but that's okay. In step 3, the policy will actually be growing tax-free. There will actually be no annual tax hit. In step 4, on death, the insurance policy will pay out a death benefit to your corporation. The payout goes into something called capital dividend account, which lets your company pay the money out to your family 100% tax-free. No tax, no mess, just millions passed on cleanly. Let's look at a numbers example. Let's say your company has $200,000 set aside. If you invested in a corporate portfolio earning 6% a year, after about 20 years of tax drag, you might end up with just $360,000 to $480,000. If you put the same $200,000 into a permanent insurance policy, it could grow to roughly around $600,000 inside the policy, and when you pass away, your family gets $800,000 in tax-free money. The difference of over $500,000 isn't about insurance, because it's not like it has better return. It's that the government isn't actually heavily taxing the growth on the insurance policy. Now, this isn't a DIY move. You need corporate insurance advisor. The corporation must be owner and beneficiary, and you must file form T2054 to access the CDA. Premiums aren't deductible, and yes, it's a long-term play. But if you're planning to building a legacy, this is how you protect it. And the takeaway is, this isn't just insurance. It's a hidden tax shelter, growing wealth, tax-free, and delivering it to you. And if you think this is powerful, wait until you see loophole number 5. Cross-corporate loss streaming, where you legally move losses between companies to slash your tax bill. So you had a bad year, maybe your business failed, or you got $150,000 in losses sitting in a corporate tax return, and you thought it was gone forever. What if I told you that you can actually save in $18,000 in taxes on a different business? Most business owners think a loss is wasted money. But if you own multiple corporations, that loss isn't actually dead. It's a dormant tax asset waiting to be unlocked. It's called cross-corporate loss streaming. Step number 1 would involve you have an operating company making $200,000 a year. Step 2 is you have a loss company called Lossco, maybe from the past venture or maybe a failed business with $150,000 of carried forward losses. Step 3 is loss company provides a legitimate service to operating company like a management, branding, or admin, and invoices $150,000. Opco then deducts that fee, slashing its taxable profit. Loss company earns the profit as income but wipes it out of its old losses. The net result, $150,000 in profit erased, $18,300 in taxes saved. Let's say you have an operating company which has $200,000 in operating income. Without this strategy, they would have paid $24,400. But with the loss stream, they now only have a net profit left of $50,000, which means they saved $18,300 in taxes. And loss company, they pay $0 because it's using a valid carried forward loss. This isn't magic, it's tax law as intended, and if you structure it right, you can take advantage of it. This isn't a paper transaction also. You would need to set up a real service agreement between companies. You would have to invoice, pay, and make it look like real business relationship. You would have services that are reasonable and plausible, not made up. You would need documentation, because if you have no documentation or no real services, that's a red flag. The CRA will disallow it and hit you with the penalties. This is how smart business owners think. Even a failed business can become a tax shield. And if you're not using these strategies, you're leaving tens of thousands of dollars on the table. So today we covered 5 powerful legal tax loopholes, from double deferral to corporate loss streaming. Most of the top Canadian business owners use these to keep more of what they have earned. These aren't just tricks. They're not loopholes in shady sense. They're strategic uses of the tax code available to anyone who knows how to structure their business right. So, if you found this valuable, hit like and subscribe. I break down complex tax strategies every week so you can build wealth the smart way. And if you want to start using these strategies today, grab our free tax loophole guide. It's linked in the description and pinned in the comments. It walks you through each loophole step by step with templates, checklists, and red flags to avoid. Because when it comes to your business, you don't need to pay more tax than the law requires.